One of the greatest quotes of all time by Warren Buffett is, "When other people are greedy, be fearful. When other people are fearful, be greedy." And right now, we are in one of the greatest opportunities that we have seen in real estate. We're going to talk about it today and why most people are not taking advantage of it.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
If you're new to the show, this is Purpose-Driven Passive Profits. The guy sitting next to me is Nate Armstrong. He's the founder and CEO. My name is Steve Warner. I am the Chief Investment Officer. Between the two of us, we have more than 40 years of real estate investing, probably more than 2,500 properties, not to mention 400 syndications. We are here. The thesis of this show is to show you how to be conscientious investors. We follow the thesis of Matthew 25, which states you should be out looking for good, solid investments and looking to double your money, not just sitting on your money, burying it under a rock. Nate, how are you doing today?
Excellent, man. Excellent.
Awesome. I love doing these shows with you. So let's just go ahead and jump right into it. Right now, 20% of the entire single family marketplace is taken up by investors. That money is kind of frozen. Why is this so? And how is this creating a massive opportunity for investors?
Yeah. And so to put it in perspective, normally in the US housing market, since they've been tracking this data, usually what's owned by investors is somewhere around 10% of the housing stock, 10%, maybe 12%. And if you're following us on video, there's a chart and graph here. If you're following us on podcast, then I'll get this link over for the show notes. But anyways, right now we've doubled it. We're in this era now where basically investors have stepped up and said, you know what, we want more properties. It started during the low interest boom of the pandemic. And that fuel ran all the way up until just a little bit ago. And so now we've got 20% of the housing market is controlled by either short-term rental landlords or long-term rental landlords, investors.
Okay, so most of the investors that I know are sitting on cash right now. They're waiting. They're like, it's going to come. But we know we're like 3 to 4 years away from seeing low interest rates again. So while all these people are sitting on cash, where is the opportunity, Nate? What is going on with this 20% of people, and why does that make something? If you're listening to this and you're like, yeah, if it's 20%, what happens if we go to 25? Who's selling? I don't understand how that's an opportunity. Listen up, we're going to jump right into that. Nate, where's the opportunity here?
Yes, so I don't believe that we're going to go any higher. I think that we're going to shrink on the investor market share. I think that some investors are going to start to sell their properties. And it's evidenced by the fact that we had a 45% year-over-year decline in investor purchases. That hasn't happened since 2006. So 2006, investors hit the brakes because interest rates got too high and they got scared. And now we're having a repeat of that. And so I think that we're going to see that 20% market share decline. It'll probably level off somewhere around the average, 10 to 12%. Who are the biggest holders of those? Well, you got long-term rentals and you got this new phenomenon called short-term rentals. The last 15 years, it's become a thing. 20 years ago, it was not a thing. Nowadays, though, because it became a thing, it got really strong, and now it's crashing in some cities. Like I think you said in Austin, Steve, it's dropped 58%. Revenue's down by 58% year over year.
Yeah, so, actually, it's over 60.
So someone that was counting on making $5,000 a month on their short-term rental is now only making $2,500. They might not even be able to cover their mortgage anymore. They might be negatively cash flowing, just trying to buy their time. And as the economy worsens, and if they don't have the money to cover that negative cash flow, they're going to sell. It's an inevitable cause and effect. And so that is really going to be where the opportunity and the swing happens with housing prices. But the housing prices are going to take a while to come down. It's not overnight. So I would say a 3 to 4 year play is wait for some of those prices to come down and then start picking up properties again, single family specifically. But in the meantime, like sitting on cash, that's like giving your money to inflation. It's like saying, you know what, inflation, go ahead and torch some of my cash every year and just I'll park it here and hide it under a rock. You don't want to do that. Instead, you want to be in assets that rise during inflationary cycles. So we know that single family might come down in prices. We're starting to see some of that. But what doesn't come down are multifamily, except for luxury. If you're going high-end luxury, there's some use cases where we've seen some of that come down. But your working class, C-class multifamily property doesn't come down because the value of it is driven by the rent. It's driven by rent, net operating income, which is primarily rent is the biggest factor for that. So that's where you want to park your cash. And then where is the opportunity in that? Well, what we're doing, Steve, is, as you know, we're buying buildings. God willing, we close on one in just a couple of days at 5% fixed interest because we got it owner financed. The one before this, we closed on at 4.33% owner finance. We have another one in our portfolio from not too long ago in the threes. And how are we doing that? We're going directly to the seller and negotiating to take over their existing financing or negotiating to make monthly payments to the seller. None of this 7% stuff in our portfolio.
So you guys just heard Nate say that. And if you're like, well, how does that happen? One, we're underwriting hundreds and hundreds of deals to find the right ones. We've underwritten 600 plus deals this year. We will probably hit somewhere between 1,100 and 1,300 deals this year. When you underwrite that many deals, you see what the numbers actually are. We're also building relationships. This deal that we're in right now, it took us more than a year of communicating with the seller, showing goodwill, making sure they knew we could close. They then said, hey, we're selling this off market. We're not even going to allow anyone else to make an offer. We want you to have first right of refusal. We made them a very fair offer. They went under contract and we got it done because of the way that we underwrote it and the communication that we had with them. So how do you make money when interest rates are high? You have to make seller finance deals happen. That's the key. And so many people are like, I don't know where to start with that. Or is that a real thing? Or how do I do that if it's on the MLS or if it's listed? How do I do these things? You can't do it with the realtor. Well, I won't say you can't. It's much harder with the realtor. You're probably not going to find things that are listed online. And when it comes to multifamily, it's all about doing your due diligence and building those relationships. Home Invest has been active for more than 20 years in the space. We have a lot of relationships, and our general thesis is to find off-market properties that are seller financed at below standard interest rates. And that's what we do in our multifamily. This is what allows us to pay out dividends right now. Who in here would love to get dividends like from day one? Right now, you see all these indicators. They're saying dividends starting year 3 or dividends starting year like month 24. It's like, no, we want something that pays out right now. That is the main thing that we are focused on. So Nate, how long do you think it will take for this curve to come down? What do you think is going to happen with the Airbnbs? We'll actually talk about that on the next episode. If you're interested in hearing more about Airbnbs, we'll circle back to that on the next episode. But when do you think this curve will come back down, Nate?
Yeah, for interest rates specifically?
Well, both interest rates and like the 20% of homes owned by investors.
Yeah, so I always fall back on data. And so I could pull out a crystal ball, certainly. I don't have a crystal ball. But I look at data, and data says that we were in that 10 to 12% range back in 2010, and then we crept up to like 15% by the mid 2014, 2016 kind of range. I don't know. I'm going to guess that probably 5 years, somewhere in that range, will probably return to the normal. Could be longer, could be shorter. Another variable that we don't know is, will the federal government get involved in the housing market? Will they print money again? If they print money, then certainly it's going to shock the system, and all boats will rise again during that era. Will they put pressure on the Fed to lower interest rates? If we get back into a 3% interest rate cycle again, then investors are going to come back in. But I think it's heading south. I would guess 4 to 5 years, somewhere in that range, it'll get back to normal.
Awesome. Well, guys, if you are listening to this and you want to hear about our latest off-market syndication deals, if you're interested in investing with us, you can click the link down below, or you can go to homeinvest.com. That will get you started with us. We'd love to hear from you. You can also drop a comment. If this is on YouTube, we will get back to you. Remember, though, like the whole thesis here is don't just sit on your cash. Don't get it eaten up by inflation. Instead, be a smart, savvy investor who finds creative ways to double your money. Follow the thesis of Matthew 22. I don't know why I'm saying thesis so much today. Must be thinking about college. Nate, anything else to add before we get out of here?
Matthew 25 and Luke 19. Look them up if you haven't seen them, but that's what we practice here for all of our investments.
Awesome. All right. We will see you next time here on Purpose-Driven Passive Profits. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors. I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose-Driven Passive Profits.